coming to you straight from Manila, Philippines. This is Rise of Bethesda. Today we're talking about the role of fintech startups in the Southeast Asian tech scene. The region's startup scene shows strength in weathering the sector's global slowdown, with fintechs emerging as top performers. Financing the future remains crucial, and Asia's regional capital markets are demonstrating how to move forward. Global investors have always been drawn to the Southeast Asian growth story as one of the fastest developing economies and home to a relatively youthful population of 600 million. This year's ASEAN Summit Chair, Indonesia, pitched that the region would continue its role as an epicenter for expansion. Even amid the backdrop of a challenging external environment, from the Russia-Ukraine war to rising inflation and interest rate escalation, there is still substance behind the Southeast Asian story. East Ventures, a venture capital firm based in the region, raised a total of $835 million in the past year across various strategies, achieving in May the first and final close of its debut Growth Plus Fund at $250 million. The vehicle aims to support innovators within the company's ecosystem of portfolio companies that demonstrate strong potential. Quote, "The successful fundraise shows that with the right strategy, management team, and mandate, capital is still available," unquote, said Roderick Perwana, managing partner at East Ventures. The East Ventures team is experiencing promising traction across its portfolio. 60% of its growth stage startups have delivered a positive earnings before interest, taxes, depreciation, and amortization, or are in the process of doing so. And more than 40% have secured a cash runway beyond 2025. At the end of May, the company had invested in more than 20 startups so far this year across sectors ranging from waste management and mental health to digital mortgages. In total, the firm has $1.5 billion in assets under management across 12 funds that are active across Japan, Southeast Asia. In the latter, it has invested in over 300 companies and was an early backer of Indonesian startups Traveloka and Tokopedia, which merged with Gojek in 2021. The firm sees particular opportunity in Indonesia and is among the most active in the market, even though Perwana admits that pace of activity has slowed due to market sentiment. Money continues to flow into Southeast Asia, as evidenced by the accumulation of $10.4 billion in the region's startup ecosystem in 2022. According to Cento Ventures' recent tech investment report, last year marked the strongest performance of the market for 3 years on record. In spite of a global slowdown, it finished up on par with pre-pandemic investment levels. Quote, "Southeast Asia will face or is already facing a correction, but the ramifications of this are not as profound as those being experienced by other emerging regions like Latin America and India," Dimitri Levitt, partner of Cento Ventures, said in Singapore. He added, "It remains to be seen whether this contraction is justified by the return to a pre-pandemic 2022 baseline or overdone as a result of investor panic. But as a firm, we take the view that when valuations are low enough, we should invest in such a market." Levitt and his VC peers remain focused on digital financial services. It is the fintech sector that they view as key for Southeast Asia, having accounted for 46% of overall liquidity in 2022, according to the firm's report. The Cento Ventures team has capitalized on this opportunity through recent investment in Indonesia's Finfra, which provides embedded finance solutions, and Philippine cross-border payment startup Acquire. In May, Singapore-based fintech startup GenFi secured one of the highest fundraising milestones across the region to date, raising $6.6 million in a pre-Series B round led by Japan-headquartered Headland Asia. The round also saw participation from existing investors such as Monks Hill Ventures. The opportunity in Southeast Asia, especially across traditional working capital and SME loans, is huge. banks tend to deprioritize this segment as it is riskier. So participation opens up to technology companies like GenFi to act as alternative lenders and to offer something that is differentiated but also commercially viable, said Susli Lai, partner at Monk Hills Ventures. She is also the co-founder of Erudify, a tech-enabled education financing company. GenFi co-founder and CEO Jeffrey Liu attributes the firm's recent successful fundraise to experience. With a background in finance, he founded Guava Pass in 2015 before setting up GenFi in 2019 alongside Justin Louis. His endeavors in the startup segment have seen him replicate the process every 1 to 2 years. Quote, "I always thought it was a numbers game, but as I've built track record, I've realized that it's more important to focus on quality conversations and connections," unquote, Liu said. From start to finish, GenFi's pre-Series B capital raise took 6 months. We had a short list of funds that we wanted to talk to from day one, and the fact that investors were already aware of us supported entry into real deal conversations, he added. To date, Liu's firm has raised $40.2 million, which includes $15.2 million in equity. But he thinks it is unlikely that the GenFi team will fundraise again before 2024, while he shared that the firm had managed to shield from some of the market challenges during this recent round. Unfortunately, this is not the case for the majority of other startup peers. GenFi's business enables digital native companies, including e-commerce or software as a service firms, to scale their ambitions by funding their growth and marketing expansion plans. So far, they have deployed $30 million across 600 plus companies. We've noticed that in the last 6 months that the VC-backed companies we aim to support are in more challenging positions in the sense that they have less of a cash runway. We're hearing that it's a lot harder for them to secure capital and that there are delays in their overall fundraising processes, he explains. This perspective is shared by Lai, whose Southeast Asian VC firm has invested in early-stage technology companies since its foundation in 2014. Reports indicate that Monk Hills Ventures has raised at least $380 million across 3 funds, and it has invested in over 40 fast-growing technology companies in Southeast Asia, including Singapore logistic company Ninja Van and Indonesian rural e-commerce startup Dagangan. In this market environment, we see that later stage deals are taking longer to complete, which means that there is even more of an imperative to ensure as long a cash runway as possible, she shared. Before the current cycle, Lai saw deals close in as little as a couple of weeks to a month, but she cautions that this is not the norm. In this environment, she believes that startups need cash and balance sheet to support funding for at least 12 months of activity. Quote, "Where our portfolio companies are concerned, the collapse of Silicon Valley Bank made indirect impact by way of sentiment. The bank had always been a pioneer in terms of its product offerings, and for its activity to be curtailed without anyone else stepping in to take on the whole business, this will alter the flow of capital throughout the entire ecosystem," unquote, said Lai. There are fewer investors that are actively deploying compared to the past. For those that are, they want to take a bit more time to conduct due diligence and get to know prospective investments better. Fewer months of runway translates to weaker negotiation power, she added. Clear path to profitability is also imperative in this part of a cycle. With it, access to capital remains open. Without it, Cento Ventures Levitt believes that startups are exposed to very steep valuation discounts. Southeast Asia's top tech companies, Grab and GoTo, which listed in 2021 and 2022 respectively, have yet to show investors that they can stem the red ink. However, this factor is not unique to the region. This isn't a Southeast Asian specific problem. We see it happening globally as well. For high-growth tech companies, the path to profitability is a long one, said Nicholas Amundsen, partner at the Hong Kong office of placement agent Monument Group. Levitt's perspective indicates that by going for growth, a startup downplays its push for profitability. However, Perwana believes that both elements are of equal importance and can progress in tandem. Sometimes people think that it's a question of deciding on growth or profitability, but it shouldn't be either or. Ultimately, any company must work to ensure profitability, whether 1 year, 5 years, or 10 years into existence. They have to be able to turn a profit eventually, he shared. And that's what we have. Thank you so much for sticking around. More episodes coming right up.